Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets where there was a slight hiccup this week. Ross gives us his insights into gold, silver, platinum, palladium, crude, the U.S. and Canadian dollars, and Bitcoin. He also has a special offer for our listeners. Mark Leibovit, publisher of the Leibovit VR newsletters, checks in from Arizona to discuss the shakeups in the high-tech market. He's concerned about the Japanese bond carry trade and is excited about the possibilities opening up, with President Trump strongly hinting cannabis regulations are about to be loosened. Mark also looks at uranium, silver, gold, and lithium. Reporting from San Diego, publisher of the Campbell Real Estate Timing Letter, Robert Campbell, gives us the lowdown on how the U.S. economy is really performing, what's happening with the American real estate market, and how the real estate bubble might play out. He also has some fitness tips for us. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Nice to be back, Jim.
Ross, what happened on the stock markets as we approach Santa time?
Well, we got a little bit of a hiccup this week. The S&P and the NASDAQ both corrected back to their 20-day moving averages. So these are rising moving averages that have provided support on an ongoing basis since April. And we got some really nice oversold readings on both of those indices. Now, they failed in November, December to take out the October highs. So basically, you got a double top in these two indices. And for the S&P, we're sitting around 68, just over 6,800 at this point. We see that they could go up and there's new highs possible. Resistance just over 7,000, and that would be a new high for the move. But we've got some target areas that are right there, just over 7,000. Now, of note here is that this transition away from the AI stocks and the Mag 7 has really been towards the mid caps and the value stocks. If you take a look at the Dow, the mid cap indexes, the RSP, which is the S&P equal weighted, so it doesn't give a bias towards those, half a dozen names that really have been driving the S&P. But if you look at those, you look at the IWN as in Nancy, that's the Russell Value Index. All of those ones made all-time highs here during November, December. So you've got this shift that's going on, and those ones only corrected back to their the big ones corrected, to their 50-day averages, the S&P and NASDAQ, but these other ones only corrected back to their 20 days, and they are holding above the previous highs. So the bias here, even though we've got volatility and a good oversold rating in the NASDAQ and S&P and getting a good bounce, percentage-wise it might be a little bit bigger than the broader or value group of stocks. The fact is that on a basis of looking forward here over the next few months, I'd expect to see the RSP, the IWN, outperform the S&P and the NASDAQ. So that's what we're looking for. There's the seasonal rally, the Santa Claus rally, clearly has an opportunity to take us into the early part of January. Here we sit on the 19th of December. So that's a fair amount of time to have a decent move in the indices.
What's going on with gold and silver?
Gold methodically higher. The move there really, if you take a look at it, has been really solid since the middle of October. And when it broke out in mid-November, there had been resistance there for about 4 or 5 weeks. And we popped through that about 10 days ago. We're still sitting shy of the all-time highs, but it's been stair-stepping its way up. And, I think back to the days in the 1970s, coming off the $100 low on the way to $850. It was just a series there of breakouts to new highs, pullbacks to support, once again doing it over and over again. And in this last week, when we took out those November highs, the pullback was very small, and here we are at the end of the week, pushing right back against the highs. We look at it and see that the miners, if you take a look at the GDXJ, the GDX, they are outperforming the bullion. That's a good thing to see. So, let's just continue to think that there's upside progress available here. And if we measure the depth of that October correction and tack that on to that high, we've got the chance to easily tack on another $400 or $500 in as far as this leg up is concerned. Now, silver, we're starting to see some excesses there. The weekly chart is giving us an upside exhaustion signal. I don't have a lot of these in silver going back, probably 10 or 12 of them in the last 70 years. But it's only once the daily chart starts to get excessive, along with the weekly, that you can be looking for an interim high. So at this point, the daily chart is like the gold one, methodically tracking its way up to new high as of Friday on the move, and the daily chart is nowhere near an overbought position right now. It was that way in November, and we saw a $4 rally or $4 pullback. We saw the same thing in the first week of December, and we had that reversal day, that $4 reversal day, but it quickly offset that and turned around in the next 48 hours. So this one is strong on the upside, but when we look at the miners, for all that they're moving higher, they are underperforming the bullion. So don't look for them to blow out the lights. The other two precious metals, the platinum and palladium, have had just a great move here in this last 6 weeks. Getting a little overbought right now, so I'd expect to see them have a pause.
What's going on with crude oil?
Crude oil is, from our perspective, has had its seasonal decline. We are sitting at 56 and change, having been down to 54.5. Starting to look a little oversold right now on the daily charts, but there's nothing on an interim basis, the daily, the weekly, or the monthlies, to say that a low is in place as of yet. So might get a bounce, maybe back towards 58 as the first level of resistance, but the trend is down. If we look at natural gas, now there's one that really has had big swings in this last month and a half. It had a 25% decline into a week ago. It's been thrashing around since then. Got some signals that would suggest that it's ready for a retracement rally. Probably retraces back about anywhere around 40% of the decline that it had from the first week of December. So Lots of volatility for traders, and the UNG or the BOIL, BOIL ETFs would be a way for the non-futures traders to participate in the move.
What's going on with the U.S. and Canadian dollars?
Quiet, basically. You know, you've got the U.S. dollar has gone itself into a trading range here. We had been up to the 100 level during November, which was the same place it had been to in August, so resistance there. The double bottom support July through the middle of September is still holding, so that broad range between 96.5 and 100 is, you know, what we're looking at. No guidance in terms of, you know, where the next big direction is right now, so we're just going to sort of stand aside on that one. Canadian dollar, once again, held the gains of the last couple of weeks very nicely as the crude oil market went down to new lows. So the Canadian dollar, a little bit on the overbought side right now, but the bias on that one is to the upside until proven otherwise. The Bitcoin market, you know, we looked at that in the last few weeks, and it's provided some pretty good signals. We got major downside capitulation in that in the better part of November. Looked for a rally back to the Bollinger Band, which was at 93,000. That was a great resistance level. And then from there, the probability is we would go down and test the lower Bollinger Band. That happened last week. So the thrashing process is in place. What we need to look at in terms of a bottom, we've got some moving averages that historically, you know, we look back, we've got 10 great examples here since 2014, where the declining process that we've had in Bitcoin, if it's going to bottom out, we know exactly what to look for in terms of an upside signal. So that we're passing along to subscribers. But for now, let's say that the trend is down until otherwise proven, otherwise different.
And to be a bit of a stocking stuffer for the holiday season, you have a special offer for our listeners.
Yeah, we're bringing back the 25% discount for new subscribers to the service. So if you go to chartsandmarkets.com, it's right up there on the front page.
Ross, best of the season.
Same to you, Jim, and all the listeners.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Mark Leibovit, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money.
Glad to be here, Jim. Appreciate you calling.
Mark, what has happened on the stock markets this week?
Oh, there's so much to talk about. Let's see where we can get started. Well, you know, the major story, of course, was what's going to happen during this time of year with Hanukkah and Santa Claus. Are we going to get the year-end rally? The market pretty much is held up, but many of the higher tech names have, come under pressure. For example, Oracle, a big stock in the AI computing world, collapsed after it had some good earnings, and Broadcom had some good earnings, but it also sold off. But then Micron, which is another big name in the group, sort of rallied here and encouraged investors a little bit. So maybe the high techs aren't going to hell so fast. You know what I mean? So that was sort of an encouragement, and sort of in a way supports the theory that maybe we can get the market to lift up a little bit here into the new year. Got to keep in mind that institutions are not in the market now. The big players, for the most part, have taken a vacation, and they're going to wait till the beginning of the year. So it's mostly retail money, small investors or smaller investors that are in the market between now and the first of the year. And I guess they have the Santa Claus feeling, and I guess they'll try to bid the market up a little bit. But I think, there's some bit of negatives coming into next year. We're just going to have to watch the market trade in January, because I think there are some, downside risks. The other big story, of course, there's so many to talk about here. It's hard to even know where to get started. You had the Bank of Japan raise its interest rates today, Friday, from 0.5% to 0.75%, which is the highest in, I believe 30 years. The 10-year yield on their bond, jumped over 2%, and that's a negative. The U.S. bond market sold off, which means higher rates here on the long bond. So despite the fact the Fed cut during the week, the bond markets are not happy. So Japan's not happy. The U.S. bond market's not happy. And this doesn't bode well, even though much of the press talks about, housing getting better with lower mortgage rates. Unless they engineer lower mortgage rates some other way, the interest rate picture, is a bit gloomy. And we'll just see how that all plays out. But I've warned about the carry trade risk in Japan as the rates continue to move up, with so much financing having been done by borrowing money on a cheap rate in Japan and then using that money to buy securities here and working off the spread. For many years you could borrow in Japan for 0% and buy 4% bonds here in the U.S. and get a risk-free return, and that game has changed. So, and then, of course, other money was used for stocks and, other investments as well. So that interest rate scenario is a bit tenuous here. Then you can also say, well, maybe, the Federal Reserve or the U.S. Treasury is going to intervene on some level. They manipulate the markets anyway. We know that, which is why I'm such a big proponent of the abolition of the Federal Reserve, which nobody really wants to talk about. But they'll come in there. Maybe they'll try to buy back bonds, do more quantitative. They actually are indicated they may do some quantitative easing, turning on the printing presses and doing what they can, which is just incredibly stupid considering what we have trillions of multi-trillion-dollar debt, and we've embarrassed ourselves internationally in the fact that we've had so much debt and acting so irresponsibly here with our housekeeping for so many years. So maybe they'll try to engineer something, not to take anything away from Donald Trump and the positives that he's created. But we do have the risk here that, there could be a Supreme Court decision coming up on the tariffs, which is sort of, I don't know if it's in the court already pending or they decide if they're going to hear the case. But if they decide against the tariffs that Donald Trump has instituted, what will that do? Will the market like it or not like it? They would definitely mean that money that has been taken in on the tariffs might have to be refunded, which is, billions and billions of dollars. Mm-hmm. So how the market would interpret that, I don't see it as a positive, but, there's so many people that were against the tariffs, maybe they would use an excuse to rally the market, but it's bad for us as a country, because we really needed to create a level playing field for tariffs, and getting rid of that Trump action, I think, is a big negative for the country, in terms of balancing our budget and getting us on a level playing field with other countries. So that's sort of pending here. Is the Supreme Court going to do something here between now and year end or early next year, which could affect that in the markets? So you got the Japanese situation, you got the Supreme Court thing hanging out there, and then, of course, we got the Venezuelan situation going on. Is that going to be another war? We're already blockading some ships. That becomes, a factor for both the price of oil and in terms of U.S. involvement there and so forth. So that's sort of a negative in the sense, because if crude oil rallies, that's a tax on consumers, and, that's an inflationary factor, which is not good for the pocketbook of individuals nor for the economy at large. So, that's sort of a quick summary of the big picture stories. And then getting down to the nitty-gritty, of course, the other big story this week was marijuana and cannabis. Now, several things are going on there. It's a long, complicated story. We could, talk about it for hours and hours here, in terms of, really what it all means. But Donald Trump enacted a executive order, forcing the DEA to reschedule marijuana from the Schedule 1 level, which is the highest risk level, down to number 3, which is the much lower risk level. And it, unfortunately, it sort of affects Big Pharma, helps Big Pharma in a way, not hurts them, because the FDA gets involved and they can start regulating marijuana and cannabis in a certain way, and Big Pharma can gain patent protection and insurance reimbursements and national distribution for it. So it might help Big Pharma, who really is not our friend. I mean, Big Pharma has created so many problems and bad drugs, and we can talk about COVID shots and everything else here for hours. But in a way, it's a small blessing for those who wanted to, take some of the pressure off on it. But the big problem is it's still federally illegal. The U.S. Congress has to get involved. Changing the scheduling, there's still issues with regards to the safe banking. For example, we need a Safe Banking Act enacted, so that right now many cash-only operations are still in that mode, and they have high insurance costs. So it's not, it's still federally illegal. I mean, the rescheduling from 1 to 3 doesn't change the fact that it's still federally illegal in the U.S., even though so many individual states have legalized it. And then on top of that, I believe there's a story here today about the Supreme Court. They were asked to hear a case regarding about cannabis, and they're trying to settle some of the disputes here with regard to the states and with regard to this whole issue, and they sort of declined hearing the case, the last I heard. So the details of it, I don't have it all in front of me right now, but it was basically a lawsuit that was asking the Supreme Court to get involved here, level the playing field, because you've got, conflicts with states versus federal. And, ultimately I think the Congress has to federally approve it nationally. It's like the inverse of prohibition. We had prohibition in the 1920s. It was illegal. We have to have a, federal act like you guys had in Canada, and just say cross board it's legal. So many complications here, because you just have, so many aspects to this thing. I've talked about this in our interviews for the last few years. So it's funny, because a lot of the cannabis stocks, which, we have a cannabis letter, and, they rallied for a while, they pulled back, and made a big move here in the last few weeks in anticipation of Donald Trump doing what he did with the rescheduling. And as soon as the announcement came out, they sold off. So the argument was, buy the rumor, sell the news. They sold the news, and now many of them have pulled back, and they had, whatever recovery they had, they lost a good part of it. Of course, they're still cheap compared to where they were in recent years, but, again, that's sort of a big story, because if you watched the White House briefing at the time, which I did, it was really impressive. I mean, you had veterans, senior citizens, you had Robert Kennedy Jr. in there. I think Dr. Oz was in there as well, and just extolling the benefits of, CBD and cannabis to the elderly and to veterans that suffered from PTSD issues. And the president pretty much said, he's been, pressured to try to break this stigma a little bit, because so many people do find it valuable. And after all, it's been around, marijuana, cannabis for 5,000 years. It's just the drug companies and so forth that have sort of suppressed it, and the legislation has suppressed it. Of course, there is misuse, just like with alcohol, just with anything else. And you can argue it's an entry drug, but, it's how it's used. I mean, there are alcoholics out there too, but we still, liquor is not illegal as it was, 100 years ago for a short period of time. So, It's a question of the user. You know what I mean? You know, it's like saying guns are bad. Well, the guns don't have minds of their own. It's the people that have the guns that have to be controlled, you know, or license them, or make sure sane people, you know, are using these weapons. And same thing with alcohol, and the same thing with cannabis or anything else. So it comes down to individual, you know, the individual's decision and control of the individual. So anyway, you know, I understand there are risks, you know, legalizing it, but I think overall, the scheme of things, it's a question of how it's used. And like I said, it's been around forever. So I'm a supporter of it because I do have friends and connections that say it just has helped them. Some claim it helped cure cancer and other things. So I guess what it does now is that since it's been rescheduled, like I say, it could help the drug companies, which I'm not particularly happy about. But it's going to allow, you know, federal involvement now in terms of formal studies and, basically research and stuff into it, which up to this point really didn't occur. It was more anecdotal. So now you're going to get the drug companies and the FDA involved to do formal studies on cannabis, which, you know, if hopefully they prove to reinforce what the anecdotal stories have told us for so many years. And time will tell with that. But our interest here is how do we make money on this? You know, if you're in the cannabis business, many cannabis companies have had problems with their taxes because of the federal illegal aspects and what expenses they can deduct. If many can't deduct expenses and the cash business nonsense. So, you know, many of the stocks have been tradable. You know, there's a little stock we've talked about on these interviews in recent months, Tilray, which was originally a Canadian company, and I believe it may still be. I'm not sure, but you know, it went public was in 2015 or something, and you know, went from $0 to $300 a share, and then the last year or so, it's been trading at 30 cents, but it moved up over 500-600% in anticipation of these events. So there was a nice trade there for people like myself who are involved in watching the market and trading some of this stuff. So I suspect the same thing is going to continue, Jim, and we'll see some trading opportunities. But it's a big story. You got to watch the news. These things are going to trade. And so many variables here, like I say, between the Supreme Court, between the Banking Act, and between the FDA, and it's really a convoluted thing. So even though it was a positive step getting it rescheduled, and Donald Trump forced the hands of the DEA, the Drug Enforcement Administration, to do this, it's only one of many steps. And the question is, will Congress and the country really get behind formally legalizing it and getting everything in the air cleared, which really needs to happen? I mean, I think the case before the Supreme Court has to do with interstate commerce. In other words, the fact that all these issues have arisen, it interferes with one of the key aspects of the U.S. Constitution regarding the restraint of trade and so forth. And I don't know why the Supreme Court isn't jumping on this and resolving this issue. But, it's sort of silly when you think about it. I mean, either, you got I don't know what it is, 20, 25 states in the United States have legalized it, and there's a whole issue going back to constitutional theory and constitutional law regarding states' rights and the fact that states have certain rights and the federal government has certain rights, but they have to respect also states' rights. And if states really want this, then the federal government really needs to compromise here and go along with it. This. I don't know if you need to have all 50 states approve, but you definitely need Congress to do it. So, I've been involved in this thing since 2014, over 11 years, when I launched my cannabis letter. And I built a bit of notoriety along the lines, and my friend Michael Campbell at the World Outlook Conference in Vancouver, made a point of that in several of my presentations, that I was one of the first out there to say cannabis is an investment opportunity in a trade, going back 11 years ago before the big run-up. So, I had a sense that there was an opportunity here. It did last for a few years, many in the Canadian sector, but unfortunately things sort of fell apart even in Canada because of poor money management and marketing and so forth. But oversupply issues, and we can go on with the long list. But so I do have a bit of a track record with this over the years, but it's been a very volatile market, and it's one of many markets we follow. And I don't want to build my whole reputation around cannabis, but I did have we had a good run with that, and I do track them. And at some point, hopefully all this legislation gets cleared up and these companies can move on, and with the FDA behind it. And I'm sure the research is going to show some positive results, because I've known people that claim and have seen it. I've seen it in my own family, people that have used it and claimed that it had some benefits. So depends on the level of THC which is in the cannabis versus zero THC, which you see in much CBD, munchies or whatever you call them, chewables. But there's still a lot to be resolved. So anyway, the week had a lot of stuff. It was a very interesting week here. And in summary, we have the holidays coming up. More retail involved, I suppose, than institutions, and much depends on what happens after the 1st of January to get a better sense of the overall market. But there's so many individual things happening, like this cannabis story out there, that we have to pay attention to.
Gold and silver had tremendous years. Or tremendous years.
Oh, no question about that. Silver into new highs. Seems to be making new highs daily. Looks like it's going to touch $70 the way it's going now. It may touch 68, 69 first, obviously, but those are sort of short-term targets. It's really, it's really a revelation and accommodation to those who've been, supportive of it for so many years and watched the market being held back. And once it broke through that big $50 all-time high level, the dam broke, so to speak, and a lot of money has come into the silver market. So it's a bit, extended here. Who knows how high is high? But there's also been action in other markets. The copper market's been doing better. And we talked about this before, palladium and platinum, how big catch-up plays. Platinum used to trade for more than gold, and it's way cheap compared to gold. So it's a big catch-up play in platinum. I remember years ago it was double the price of gold or more, and now it's a fraction of the price of gold. So, besides silver, you got to look at these other markets that have big catch-up potential. So the question is when and if we will at some point see some correction in the metals, and we just have to watch the charts. Nothing goes up forever, and there are corrective levels, so to speak, if you look at the charts under the market in both gold and silver. But apparently at the moment momentum is behind them, and you just have to decide, are you trading or investing? So we could talk about gold I bought in the 1980s, at $500, and how many years it took to get to these levels. So do you have a 30, 40-year time frame? Do you have a 6-month time frame, a 2-minute time frame? What is your time frame for it? And the bulls, of course, would argue that with the U.S. debt and with world political situation, what it is, and the involvement of the BRICS nations, and all kinds of uncertainty out there, you have to own it. But you could also have argued that for 5,000 years that gold has existed as well. So we don't live forever. And is it a hedge? Is it a hedge forever, or will it have a sharp correction as it has in the past at some point? And much depends on whether the government gets involved in a certain level. Remember, they confiscated gold here in the 1930s with President Roosevelt. Could it happen again? Many argue that it says it couldn't happen. But, you get a change of administrations. Anything is possible. So you can sit and worry about it forever. The moment seems to be in the hands of the bulls. And like you said, we had a great year.
What's going on with crude?
Interesting there. I've been a bear on it for pretty much a good part of the year, looking for a pullback maybe to first the mid-50s and maybe the high 40s. And it seems to be trying to bottom here a little bit. You've got the Venezuela situation going on. And, just looking at the chart, it looks like it's maybe trying to bottom here a little bit. So I'm sort of neutral on it right here. I play both sides, long and short. I don't have a position right now, though I like some of the individual oil stocks that generate some nice dividend returns. So apparently the oil companies can make money and pay out some nice dividends regardless. And I don't want to mention names. You can get that in my newsletter, but they are out there. So the shares seem to be a better bet in terms of getting a nice dividend And as far as the direction of oil, I would sort of bet that it may go higher, and which is not good if that happens, because it becomes a tax on the economy and a tax for individuals, and could add to inflationary risks. So I guess a lot depends on what happens in the geopolitical sphere right now with it.
Anything happening with lithium?
Lithium has done well. Yeah, the chart has been going up and improving. Uranium, on the other hand, has had a big of a correction. CCJ, Cameco, the big name, topped out things back in August, come down, now treading sideways. It got overdone, I thought, to the upside. So a lot of the uranium expectations, look too far into the future, and the market's trying to discount that now a little bit and say, well, maybe we went too far too fast. So had a little bit of a pullback. Still, there's big support for the uranium projects, the nuclear projects. So, it's a bullish case overall, but that's a multi-year comment, not necessarily, month to month. We've had a big run already in many of the nuclear uranium plays, and now they're sort of consolidating their gains. So with one exception, one big stock, which I mentioned before on the air, that went to a new high in the last few days. For most part of them, most of them already made their highs, and they're sort of trending here. So you have to make a decision. Now, where are you? I mean, how fast is the nuclear projects going to get implemented? Is too much money been put in there too fast? Is it going to take several years, or what period of time to get these projects underway, to get the plants built, to get the energy centers built? So this is all related to the AI demand. That's why nuclear became popular, because the greedy people that run Microsoft and all the big companies who demanded energy centers to run their AI programming decided that nuclear was important now, where for many years it was poo-pooed and too dangerous. So now suddenly the big money jumped into it. Many are arguing too much money too fast. It's going to take too long to get these projects underway. In fact, some communities are revolting against the data centers that are being built or about to be built, because they interfere with data access in those areas and all kinds of zoning issues. So there's some conflicts, developing here in terms of how fast some of these data centers are going to be built, and this all ties into the nuclear uranium component, so to speak. So some argue, well, maybe we'll use natural gas instead if we can't get the nuclear stuff up and running right away. So, it's like a mania. Too much too fast. It's not my type of market. I'm more of a trader. I don't really, stick with this stuff, for 2-3 years at a time. And many of the listeners out there just love to hold for many years. That's not my approach to the markets, but I think it's been overdone, and we'll just see how it plays out next year. But I think even the experts are saying it's going to take time to get these projects underway, and we went too far too fast in our pricing of some of these stocks.
Anything on the geocosmic front we have to be keeping a close eye on?
Well, there's not much new here in terms of solar activity. There's just a lot of, jabber about the Atlas comet that's been out there, for the last, 2-3 months that all the press has been talking about. So it's called the 3-1/Atlas, and it's actually today on the 19th. It has it's making its closest approach to the Earth today. So what does that mean? Well, it's passing 270 million kilometers away. Now, that's a pretty big distance, but that's the closest it's come to the Earth. And they'll be able to photograph it and get more, more insight into it. The speculation, most of the official astronomers, have just discounted the alien intergalactic theory about the whole thing. One of the big proponents or experts have discussed that possibility is Avi Loeb, the astrophysicist at Harvard, who's become pretty much the spokesman for searching not our galaxy as much as our solar system, and monitoring objects that come through that don't conform to normal, patterns that might indeed be reconnaissance craft or surveillance craft from other galaxies or other solar systems passing through. So was Muma. I forgot then how to pronounce it. Who passed through the solar system in the last few years. It was named after the Hawaiian name of some god or something in Hawaii. I forgot where the name came from, but it was a Hawaiian connection. So it passed through our solar system and didn't conform. Just kept going through. It didn't conform to normal gravitational forces and so forth. So Avi Loeb at Harvard was long discussions about how that could have been a probe from another civilization that was passing through our solar system. So he's always looking for stuff. So this AT3I or 3-1 Atlas apparently had some aspects to it that didn't supposedly conform to normal comets. And in the last 2-3 months, there's been a lot of talk in the astronomy community about, whether this thing is intergalactic of some kind or just a normal comet. So most of the scientific community wouldn't agree with an Avi Loeb because they don't like to talk about stuff like this. They're afraid for their jobs, or they're afraid they're going to be labeled believers in alien civilization or some nonsense like that, which is ridiculous because we know there's alien civilizations out there with the billions and billions of planets and the size of our universe. So, and evidence that we've had visitors to this planet in the past has already been documented by many who look at this type of stuff. But official point that being made is, just a normal comet, and it's closest to the Earth now, so let's photograph it and forget about it. So that's the most current update on the geocosmic. The other thing I would mention in passing, of course, is that we're in the time frame for the winter solstice, which comes up here just before Christmas. And I've noted in my newsletter for decades and also on these broadcasts that sometimes you get changes of direction in the market. It doesn't have to be on the same day, within a few weeks of the various seasonal patterns, which come in December, March, June, and the various 4 seasonal time frames, including the winter. So maybe we're in that seasonal time frame now for a change of direction, which would mean markets are topping out and we're headed south when we go into January, February of next year. So that's one way of interpreting that, if you use the seasonal patterns as an indication of a possible change of direction. So we're seeing some signs of that now. The markets are overbought, and there's been nervousness in some of the big name stocks, which are overdone. So we'll just see how it plays out into next year. So I just keep a watch on it. I just know this is a good time frame not to be getting overly excited about the markets. It's best to let, if you have profits this year, I guess you could wait to January 1 or January 2nd, so you can defer your taxes until next year. But I'm pretty sure, based on my experience, most of the savvy money managers already took their profits because they get compensated on performance and they didn't want to take a chance of losing their fees. So I think many of the big money managers have already rung the register, so to speak, and they're going to wait till the new year to make new decisions.
Mark, thank you so much for being on This Week in Money, and best of the holiday season.
Happy holidays to everyone. Thank you, Jim.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRtrader.com. He was speaking to us from Arizona. Coming up, Robert Campbell, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Robert Campbell, publisher of the Campbell Real Estate Timing Letter, his website, realestatetiming.com. He's speaking to us from San Diego. Welcome back to This Week in Money and best of the season.
Thank you very much, Jim. Thank you for having me.
Bob, what's the state of the U.S. economy? I mean, for real.
Real economy.
Yeah.
It's, even though reported GDP is up around, 2.5%, 3%, which is, it's not weak, but that's fairly strong. The U.S. economy is struggling right now. It's struggling. the American consumer is having a real hard time with inflation. The inflation numbers that the government reports are crap. They're unbelievable, and that's the problem right now. I listened to President Trump's speech last night, and he said American wages are rising faster than inflation, and that's 100% not true. That I think I looked something up, and I said average wages in the last 12 months have gone up 3.9%. Well, the government reports inflation at like 2.8%. So that means there's a real gain of 1.1%. The problem is what the government reports as inflation is completely inaccurate. Add 4 or 5 percentage points to it, and you're probably in the ballpark, if not more in certain areas. So the average American is having a hard time right now. And a consumer survey came out. I think it was Michigan or one of the big ones that goes back like 50 years. And even it showed a comparison between the U.S. stock market going back like 5 years and consumer sentiment, how U.S. consumers grade the economy. Great, good, average, or poor. Stock market's hitting record highs, but the consumer sentiment, how the average consumer that feels about the economy, it had the second lowest reading in history. So, our politicians, even our President of the United States, can stand up there and say, oh, everything's great, the stock market's at record highs, prices are coming down. It's not true. It's not true. I mean, and if it was true, who are you going to believe? Like 50, however many people took this poll, let's say it's 20,000 people took this poll and said they're having a hard time, or the President of the United States that says everything is great. So you got to believe the people. So the U.S. economy is struggling right now. And unemployment just went up to 4.6% or something. That's a 4-year high. So that's just what we need right now is rising unemployment, inflation that's much worse than the government's reporting, and that's why people are having a hard time.
Talk about inflation. Even the White House ballroom, it started off at $200 million, and now the president says it's going to cost $400 million. So it's doubled in price in just a few months.
And my background, everybody, I'm from the building business. I've been around building my entire life. My dad was a builder-developer. I was a builder-developer. And the cost of materials right now, I'm still pimping out my house, doing real high-end improvements, all my own labor because I know how to do it. But you go to the lumber yard, and I'm shocked at how much material costs. It isn't up 2.8%. If anything, it's probably up, like in the 7 or 8%. I bought some tubes of adhesive caulking for some work I was doing. I bought some last month, and it was like the same kind of tube. It was $5 for a tube. Next time I went to buy some more, it was $7. It went up $2, and that's just not an isolated incident. It's like what do you believe? Your lying eyes or what somebody tells you? Inflation's much worse than the government's reporting.
Oh, well, you talk about building materials here on Google. The U.S. has imposed a 45% tariff on Canadian softwood lumber, the preferred lumber for housing construction.
This whole tariff thing, I don't understand it at all. My background's economics. So I understand economics way better than most people, but this whole tariff thing, there shouldn't be tariffs on anything. Just if somebody can build a product cheaper than you can build it, buy it from them. And if you do something better than somebody else, and you're damn well better if you're going to be a developed company, you do that better. And so, but this putting tariffs on things like that, I just don't see where that's going to help anything. And where the U.S. really screwed the pooch was for the last 30, 40 years, we've been outsourcing all of our manufacturing to low labor cost country like China, Vietnam, Mexico, right on down the line, Korea, that kind of thing. And now the president wants to has imposed all these tariffs, to bring manufacturing back in the United States So that, just for an example, that car that was built in China that sells for $50,000, that because laborers are working at so much more cheaply than Americans, they're going to bring that manufacturing into the U.S. That's not going to be a $50,000 car. That car's going to cost $65,000. So I don't know how that's going to work out. I mean, the American labor costs are super high compared to like these low labor cost countries. So bringing it back to the United States is going to help everybody? I don't think so. Because, it's just not going to happen. And I don't know what the end result of this is. I mean, I just think it's kind of crazy.
What's the state of the U.S. housing market?
U.S. housing market it's on its last legs. That's where that is. And what's interesting about the U.S. housing market is that there are some areas of the U.S. housing market that are still doing well. There's other areas that are doing very poorly. And the areas that are doing poorly are those areas that after COVID hit, when the average price of a U.S. home went up 50% in 5 years, the areas that shot up the most, like Texas, Florida, and a few areas like that, their prices are coming down hard. Versus other areas, like in the Midwest, like in Chicago, Wisconsin, Michigan, Indiana, the places that are super affordable relative to the high-priced areas, they're doing very well right now. Some of those areas are appreciating in the range, 5 to 10% a year, where other places in Florida and in Texas, are falling 5 to 10% a year. So the market's changed. And normally you don't see a bifurcated market like that. When the normally when prices go up, every place kind of goes up. So, but right now I would say in the United States, 55% of all major housing markets are still rising in value. Very little. I mean, maybe 1% a year. Whereas, 2 or 3 years ago, they were rising at 6, 7, 8% a year. So the average year-over-year growth of home prices has fallen for something like, almost 18 straight months. So it's coming down. It's coming down, so pretty soon we're going to get to the edge here of the cliff where that everything is going to start falling. Everything is going to start falling, but we're not there just yet.
How has housing affordability changed since the start of the pandemic?
It's gotten so bad, terribly bad, since the start of the pandemic. I mean, that's why when houses went up 50% in 5 years, do you think did wages go up 55% in 5 years? No, not even close. They maybe went up 10 or 15. So that's why they're so affordable. And here's what's really crazy, guys. And I wrote about this in my last timing letter. I write a real estate timing letter every 2 months. And since 2021, which was, 1 year after the start of the pandemic started about the mid-2020. In 2021, the average age of first-time home buyer was 33 years old. Fast forward to 2025. So we're talking 4 years. Now it's 40 years. 40 years. That's the average, because that's how expensive housing prices have become. And all buyers that buy homes in the United States, in 2021, the average was around 45%. You know what it is today? 59. The average age of the American home buyer today is 59 years old. First time, repeat buyers, and all of that. And now the government's now the government's coming out with that supposedly going to help affordability and help the struggling home buyers with a 50-year loan. Okay, so let's say your first-time home buyer, he's 40 years old before he can afford to buy a house, and he buys a home with this to make it affordable, a 50-year mortgage. What that means, his home is going to be paid off at age 90. This is the new American dream, folks. That's how crazy, that's how bad affordability is in the United States. Yet the President of the United States keeps saying this affordability is a hoax. I mean, who's he trying to fool with this? It's super, super bad. And what happens when unaffordability gets that high happens every time, guys. Housing prices come screaming back down. That's happened ever since the world began. That's just the way the world works. If you can't afford a house, unaffordability gets to a certain level where it's extreme, and then people can't afford to buy a house. Then nobody can buy a house. Then all of a sudden, if you want to sell a house, you got to lower your price. Now prices are coming down. Now fear psychology starts taking hold of the market instead of greed psychology, which feeds upon itself, and now you're in a down cycle. And that's the way it works. So we're still we're not in a greed cycle, but the fear cycle hasn't kicked in yet, where people are going, whoa. I mean, on average in the United States, Texas, Florida, yeah, people are losing money on their houses. And here in California, the weakest housing market is the Bay Area. Housing prices have, I think they're still like 10 or 15% below their mid 2022 peak. That's the worst housing market in California.
Do we live in a two-tier economy?
Absolutely. Since the start of COVID, there's two types of people. The people that own assets, real estate, stocks, gold, they're at all-time highs. And the people that's the top tier. The other tier that is working for wages, which aren't even keeping up with inflation, that's the other tier. They have nothing. They've made nothing. Those are the ones that are struggling. So on average, that's the two-tier market. If you don't own assets nowadays, you are getting killed. I mean, because of inflation.
How has Fed policy changed in the last year?
It's changed a lot. Okay, up until about 2 months ago, prior to a month ago, the Fed had cut interest rates twice. Now, when the Fed cuts interest rates once, that can kind of be, you can't read too much into that, because they do that on and off every once in a while. But when they cut interest rates twice, Fed fund rates twice, now you know that something's going on. And just last month they cut it again for the third time. So the reason, and even though inflation is still, let's say, even what the government reports, the Fed supposedly has a dual mandate where they say they got to keep employment high and keep inflation low. Well, their Fed target for inflation, even if those bogus numbers the government reports, is 2%. So let's just say it's at 3%. So we're not even at the lower target, and the Fed's dropping interest rates. Why are they doing that? Because the labor market is a lot weaker than people know, and that's why they're doing it. And so not only that, they've had a major shift in their policy away from quantitative tightening, which is what they were doing. They were buying bonds on the market, taking money out of the system to buy back bonds, to quantitative easing, where now that they were selling bonds into the market. Now they're in quantitative easing where they're buying bonds. And so they're borrowing money. They're not borrowing money. They're just creating money out of thin air and buying bonds on the open market. So there's increased demand for the bonds, which means the price of bonds is going to go up because of increased demand. When the price of bonds goes up, interest rates go down. They're trying to lower interest rates. They gotta lower interest rates. And the biggest reason they're lowering interest rates, I mean, of course, borrowing costs is a big deal, but the biggest reason they're lowering interest rates, in my view, is the national debt. The national debt, right? I think last year we paid like $1.25 trillion in interest. You don't have to go back that far in time, like 5 years, 6 years, 7 years, when that number was $400 billion. Now it's almost doubled or tripled since then, because the national debt has gone up so much. They've got to drop the interest rates, or pretty soon, the national debt's going up, $2 trillion, probably $3 trillion a year on average. It keeps going up and up. And if interest rates stay high, which they may do anyway, pretty soon it's going to go from $1.25 trillion to $1.5 trillion. And keep going up and up. And we don't have that money. Now we're borrowing money to pay interest on the national debt. That's very, very bad, guys. But so the Fed's doing everything they can, probably for political reasons, to get the debt servicing costs on the national debt down. Also, we have a midterm election coming up in 2026. So, they're gonna doctor the economy up the best they can to make it look good. So whatever party's in power has a chance of staying in power, right? And there's multiple reasons, but the Fed has done a very, very significant 180 from quantitative tightening to quantitative easing, and I understand that they're buying minimum. I think it's $40 million worth of Treasury securities every month now. They're just buying them on the market, to increase the demand, increase the price, and lower interest rate costs.
Does the Fed control mortgage rates?
Not directly. They do so indirectly. And here's why. That when the Fed, controls short-term rates, and that has an effect on the 10-year Treasury note, which isn't real short-term, but it's not real long-term. And the mortgage rates have historically traded off of the 10-year note. So all of a sudden, when we're going to have QE here, the 10-year note rate is going to go down, and theoretically at least, mortgage rates are going to go down. So the mortgage rates should go down in the coming years. But here's the kicker, guys. At these high levels of unaffordability, and I know everybody likes to say, gee, we need we need greater affordability, bring interest rates down, and we'll revive the housing market. No, that's not going to happen. Why do you say that? Just look back in history. Like here in California, for example, which is my stomping grounds, where I grew up in. During the 1990s, we had a housing downturn from 90 to 96. What mortgage rates do during that downturn when housing prices went down 15% nominally? Mortgage rates went down 2 percentage points. I mean, housing prices didn't go up. They went down. How about from 2006 through 2012 when housing prices in California, the median price house fell like a little over 50%? What happened to mortgage rates? They went down 3 percentage points. You mean mortgage rates went down 3 percentage points and housing prices still went down? Yeah. So that's what happens. Once housing prices get so high that they're unaffordable, that super unaffordable, a few percentage points in mortgage rates isn't going to move the needle that much. It isn't. What you need is lower prices, and that's what happens. And so that's what we can expect going forward. It's lower housing prices, not, dropping the mortgage rate from current, in the low 6s to 5 or something like that. That ain't going to make a difference, guys.
President Trump says wages have grown 3.9% in the last year in the U.S. Is that good?
Well, it's whether it's good or bad, it's true. So, yeah, and they say, okay, like I mentioned before, they said wages are growing faster than at any time in a long time. And maybe nominally, yeah. And he said, and inflation's coming down. No, they're not coming down. That's just because you say inflation's coming down, that doesn't mean it is coming down. Because those government numbers on inflation are so cooked. So that's where the wage earner is getting killed right now. Anybody that owns a house, anybody that owns stocks, anybody that owns gold, they're just really raking in the net worth gains. But if you don't, you're getting killed. And most people don't own that. Here in the United States, the 50% of the stock market is owned by the top 1% of the richest people in the country. 50%. So let's take it down a little lower. Let's take the top 10% richest people. How much of the stock market do they own? 90. That's how concentrated the wealth here is in this country. My dad was a Marine in World War II, came back, started building homes. The hardworking guy, no college, but all of a sudden he made a real good living for us and our family, and we did well. That was the golden age of the middle class, from like 1960 through maybe like 1980. After that, after we went off the gold standard, and in the 71, and inflation started taking over, the middle class, the middle class it's becoming smaller and smaller and smaller. So now you need to have money to use inflation to your benefit, and poor people don't do that. And that's why the difference between the rich and the poor in the United States is getting greater and greater. I know people support statistics. Oh no, the middle class is still there. They're doing well. No, they're not. I mean, let's get real about this. Let's not be political. Let's just look at this as real dollars and cents. How the average guy's doing. How the kids are doing nowadays. Christ, most kids graduate from college nowadays, and 50% of them move back home. When I graduated from college in 1969, you know what percent of all kids move back home? 0. And we could afford rent. We could go out and get a job and have an apartment and live a good life. And I mean, even if you had to shack up with one of your guy friends or something to split the rent, that's what you do. Today's kids can't afford that. Today's kids can't even afford a car. So when the president's sitting here saying that affordability is a hoax, nothing could be that's 100% political. That couldn't be any farther from reality.
Is housing a bubble?
Absolutely. It's a bigger bubble than last time. Bigger bubble than last time. And just look at a chart, see the prices. So what that means is the correction, it's going to be another huge correction, especially if you take inflation into account. It's going to be a huge correction. Like Warren Buffett said, he goes, the bigger the binge, the greater the hangover. It is absolutely true. It's all going to come down. And if you don't believe that, just go look at a chart of real housing prices that goes back 50 years. Up, down, up, down, up, down. Now, you could say, oh, it's different this time. Okay, you may be right. You probably stand a 5 or 10% chance of being right, and a 90 to 95% chance of being wrong. You don't get ahead in life on those kind of odds.
Will home prices crash from the current bubble the same way they did after the last bubble?
Oh, that's a really great question, and the answer is no. That people think that this current crash, correction, downturn, however you want to describe it, it's going to be the same as the last one, and it's not. What happened during the peak of the last bubble, and in 2003, 2004, 2005, 2006, 6 was the peak in most places in the United States. What took over was this, creative mortgages where you needed no money down. You didn't have to stated income. You could say whatever you wanted was your income. You could say it was that's what you could use and to get a mortgage. And so everybody was buying a home that couldn't afford one. And even then, even when you got a mortgage, it wasn't a 30-year fixed. It was some adjustable that had, that less than interest-only mortgage payments for the first year, 2 or 3, whatever the mortgage program was. And then all of a sudden, it kicked in where the loan started amortizing. So maybe when you bought the home, the payment was like, let's just say, for example, $1,000. And so, even then, most people could afford it as long as prices are going up. Then all of a sudden, 4 years later, 3 years later, it started amortizing, and the mortgage payment went from 1,000 to like 15, 16, 1,700. Now people are totally screwed. So the result of that was jingle mail. Housing prices came crashing down. There was this artificial demand. People were buying houses that they really couldn't afford, driving the home prices up. So all of a sudden, home prices came crashing down, and in no time flat, people were underwater on their mortgage. They had no money in it anyway. So what they did was they just took their, proverbial, keys to their home and mailed it back to the lender. So what that resulted in was a massive surge of foreclosures that hit the market all at once. And prices just crashed during the first couple of years, 2007, 2008, 2009, super fast because it was driven by foreclosures, which is, there's nothing worse, for home prices than to have your neighborhood, houses for sale that are in foreclosure. And houses prices came down. This bubble is different. There's no more of that creative financing. the no money down, no income, no job. You don't even need to have a job, or you can make up a job. None of that. People have to qualify for a mortgage now. So the mortgage borrowers are much more solid than they were during the last bubble. But here's the problem. Here's how the prices are going to come down. Everybody right now is, a lot of people have, 3% loans, 4% mortgage loans, so they really don't have to sell. But on average, about 1 out of every 7 to 10 homeowners has to sell every year for some reason or another. Death, they lose their job, they have to relocate or something like that. And now, all of a sudden, and there's these people that do have to sell, and housing demand right now is like at a 20-year low. They're going to have to mark their prices down to get a seller, to find a buyer, because unaffordability is so high. They can sit there and go, well, housing prices haven't crashed that much. Yeah, and there's no demand either. Yeah, there's nothing selling. It's just sitting there on the market. So now they wanted, for example, $100,000 for their house. $100,000. They've got a lot of equity in it because it went up 50% during the pandemic. They got a lot of equity in it, and they go, hey, well, the last house on the neighborhood sold for $100,000. Yeah, that was 2 years ago. Has there been any activity since then? No. Has affordability gotten better? No, it's gotten worse. So, can you sell your house for $100,000? Probably not. What are you going to have to mark it down to? I don't know, 90, 85? And that's how prices are going to come down. Because if they need to find a buyer, they need to get a buyer that can afford a mortgage and afford to get a new mortgage. And that isn't at $100,000 at these housing levels. So that's where the housing prices are going to get marked down by the sellers, not the banks. And that's going to cause the trend reversal. And that's totally different than what happened during the last downturn.
What housing indicators are you currently watching most closely for a sign that the party's over?
The party's over. So for some of the new people that are listening to this, I wrote a book, Timing the Real Estate Market, back in 2002, and there's 5 key indicators that I use, for timing markets. And they're all really, really good, still really good. Today, however, what I'm using most is, I didn't know about affordability indexes 24 years ago, and I didn't know about month supply on the market 24 years ago, which is why I'm writing a new book. But those are the 2 key indicators to watch right now, guys. Affordability and months on the market. And here's the deal with months on the market. You look back in time, it's all economic supply and demand. Because right now there's like 4.5 months supply on the market. Okay. Is that low or high? That's low. When supply is low, what are housing prices, houses for sale, when that's low, what do housing prices do? They go up. So prices are still slowly going up. But once, and this has been statistically proven. You can look at the statistics and go, wow, how come nobody talks about this? I don't know, but they should, or at least they should follow it. But until months supply on the market gets at 6 months or above 6 months, that's when the trend's going to turn. Because now right now there's the housing market is slightly rising prices are driven by scarcity of homes for sale. Once that gets above 6, that's all going to change. Now there's more homes for sale than there are potential buyers, which isn't the case now. It's just the reverse, and that's when things are really going to turn. So if you had to watch one indicator right now, everybody, in your area or nationally, whatever the case may be, watch month supply on the market. And you can look at it, it's such a statistically reliable tool. It's almost criminal that some people know about this and other people don't, because it's a really, really good timing tool.
How is the home price to gold price ratio doing? What's the better asset to own right now?
There's a gold to home ratio that I've followed for years, and the ratio changes. Sometimes it's better. It's more profitable to own real estate than gold, and the ratio reflects that. It trends that direction. And other times it's just the opposite. It's more profitable to own gold than real estate. That ratio changed in favor of gold about 2.5 years ago. And it's still trending in that direction, guys. So right now, knowing that things trend and that, that not everything's in favor all the time, would you rather own gold or real estate? You'd rather own gold. I mean, and we're talking about, not talking about gold on a real estate, we're talking about gold paying cash for it, not leveraged. I mean, but still, so the price of gold is outperforming real estate by a lot. And what's amazing is this. You might go back in time, I forget the exact numbers right now, but when this ratio changed in favor of gold over houses, I think it took something like, and I'm just throwing these numbers out as an example, guys. Let's say it took 1,000 ounces of gold to buy a median-priced home in mid-2022, which was essentially the peak of the market based on when adjusted for inflation. Let's say it took 1,000 ounces. You know what that number is today? 500. Somewhere around there. It's about half. In other words, if you bought gold, now it takes only 500 ounces to buy the median price house. And when this correction is finished on the downside, completion of the cycle, the full cycle, now the cycle to the downside, I think it's going to take about 150 ounces to buy the median priced home in the United States. And then the world changes again. Now houses are super cheap relative to gold. So you take your gold, you buy the house, cheap at a depressed price, ride the cycle up, and then, at some point in time, sell your house and buy gold again. But that cycle has repeated over time. It's not as crystal clear as some of the indicators I watch, but I know what's going to happen I've had a strong feeling what's going to happen to the price of gold, for a lot of reasons that, are, related to the health of the U.S. bond market and the U.S. dollar. And so I like gold right now a lot. And, in the last year, I mean, what's gold gone up? I think gold's like $4,300 an ounce right now. You don't have to go back a year or two, and it was 2,000. So gold is kicking butt, and housing is struggling to keep its head above water. So if you had to do one or the other, look at that ratio, gold to home ratio, and it's you can see how it's trended, and watch the ratio how it's trended over time, and what's happened to the price of gold when it's moving that direction, and what's happened to the price of housing. So it's a real cool indicator. So that's one of the ways I'm trying to stay out of the homeless camps and eating out of garbage cans.
What's better, socialism or capitalism?
Guys, that is, and I put that question in.
Mm-hmm.
I really don't understand how somebody can want to be a socialist. I really can't understand that. Now, let me give you a little bit of background. My dad was always self-employed. I was always self-employed, and we did just fine. But by saying that you want to be a socialist, you're essentially saying you don't trust yourself to run your own life. You can't do it. You'd rather outsource it to bureaucrats who've never built anything, never risked anything, and only know how to regulate, tax, and expand their own power. So, so if you're for socialism, is what you're saying is, I don't trust myself, please control me. And that, I just can't understand how people feel that way. Why they feel that life is that desperate where you don't even have control over your own destiny? Of course you do. So that's why I say, I'll never be a socialist, ever. Capitalism, even with all its defects. It by far it delivers the greatest benefits to the population as a whole.
Bob, do you have any fitness tips for us today?
Yeah, I got a really good fitness tips for you guys. Okay, working out, running, working out, staying fit. Is that a lot of work? Yeah, it is a lot of work. There's no doubt about it. It's a lot of work. And the fact that it's a lot of work is what makes most people, lazy people, say, I don't want to do it. And they don't do it. So now they're not physically fit. And if you're not physically fit, you're not healthy. And living your life unhealthy is no way to live. So here's the way you got to look at it, guys. And I learned this from the cartoonist Scott Adams that writes the cartoon strip Dilbert. Don't focus on the effort. Focus on the outcome. And if I was you, I would write that down. Because as soon as I heard that, just wow, it just went. It was just like the light bulb in my head went off. He's absolutely right. People focus on, oh God, I got to go to the gym. I got to lift these weights. That's really hard. Or I got to go out and run 4 miles on the beach every other day. That's real hard. Yeah, it is real hard. What's the outcome? You're physically fit. You're healthy. Yeah. Does the outcome outweigh the effort? Yeah, by 10. Then don't even screw around thinking about the effort. Just do it. Just like Nike says, just do it. So don't think about the effort, think about the outcome. I want to be more physically fit. I want to be healthier. I want to be stronger. I want to do great things when I get older in life and not be just being able I can barely walk or need a cane. I don't want a cane. How do you do that? There's certain things you can do to work out. Take care of your legs. Work out. So you don't need that. But focus on the outcome, not the effort, guys. That's my fitness tip.
Bob, thank you so much for being on This Week in Money and Best of the Season.
Thank you very much, Jim.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter, his website, realestatetiming.com. He was speaking to us from beautiful San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and Robert Campbell. And thank you for listening. If you have any questions for the show or for any of our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.